Hello there everyone, today's video is all about tax and loan relationships. So loan relationships is tax jargon for the tax treatment of certain types of debt with financial institutions or indeed positive cash balances. So for example, a limited company. Now this loan relationship world applies to limited companies. So we're not talking about sole traders or partnerships. So you've got a limited company and it's got a loan from a bank. So it's got a loan from a bank and that is a loan relationship. And it pays interest on that loan. That is what we call a loan relationship debit. So there's a debit entry to the profit and loss account, tax deductible in the accounts. Now assuming same company or another company has a big cash balance with a bank and they receive bank interest. That is what we call a loan relationship credit, and that is taxable income. So loan interest taxable, loan interest received is taxable, loan interest expense tax deductible. Fair enough? Okay. So, but what about the situation where, let's say, the bank all of a sudden decided to waive the loan? So they said, look, you don't have to pay back the loan. Excellent. Okay. Now, what are the tax implications if that ever happened? So let's just take an example. Let's just say 100 grand, and you've got 100 grand creditor on your balance sheet, amounts owed to a bank for bank loan, 100 grand, and the bank says, you know what, you don't have to pay it back. What would you do? First of all, from an accounts point of view, well, you debit the loan and credit the P&L. You've got to credit somewhere, so you credit the income statement. And under the loan relationship tax rules, that credit would be taxable. You would pay corporation tax on that windfall. That 100 grand you've all of a sudden don't have to repay because it's been written off. It gets written off to your profit and loss, but it's a credit and it's a taxable credit. Now, a long-winded introduction to the purpose of this video. This is all about a recent court case where the numbers at stake were a lot more than 100 grand. So in this particular case, there was a limited company which had a bank loan where it was indebted to the bank for £3 million. Now, the bank was embroiled in one of these swap scandals that have hit the headlines where basically the bank tried to sell this company all sorts of products to hedge against interest rates changing, fluctuating, all that kind of thing. It's a bit of like a mis-selling thing, a bit like PPI. And the company took the bank to task over this, and basically the bank agreed to compensate the company for, say, £5 million. So there was already a debt owed to the bank for £3 million, and as a redress for this mis-selling, the bank said to the company, we're going to give you £5 million. Now, how did they do it? Well, they said, we'll just release the £3 million loan that you have to us, plus his £2 million of cash. That's what they did. So, coming back to my point on the loan relationship rules. So that was, the release of the loan was a credit to the P&L, but the company on their tax return, they said, look, this doesn't play by the normal loan relationship rules. It's not a release of a loan to do with the debt itself. This is all about the redress on the mis-selling. That's just the mechanism for us to get compensation from the bank that they're going to waive the loan. And so they didn't put it in their tax return, their company tax return, as a taxable credit because they said that it doesn't play under the normal loan relationship rules. HMRC didn't agree with that. They opened an inquiry. They said, no, it's to do with the fact you've got a loan and the loan has been released and your credit's gone to the profit and loss account. So we want corporation tax on that £3 million. Thank you very much. The thing went to court, went to the tribunal, and this is what transpired. So the company basically put forward the argument and said, look, this amount is a capital receipt. It's not the discharge of a loan, even though, yes, it is, but it's nothing really to do with the makeup of having the loan in the first place. It's all to do with the fact that we are due compensation, and compensation not taxable in this instant, doesn't fall under the loan relationship rules. HMRC said, yes, it does. It's all part and parcel of the loan. The loan's been released. Like I said at the top of the video, when you get a release of a loan, it is a taxable credit in the profit and loss account. So the tax tribunal sided with the taxpayer. And HMRC lost the case, and it was decided that this release of the loan to the bank was not taxable in the hands of the limited company because it didn't come under the auspices of the loan relationship rules. It was a redress for mis-selling these swaps, and therefore it fell outside of the scope of the loan relationship rules. So, not taxable. For the release of the debt to be taxable, there needs to be a direct and causal link between that release and the underlying debt. Well, there was not that direct and causal link. Like I said, the whole release of the loan was part and parcel of the package of measures that the bank said, yes, this is going to be how we're going to redress the mis-selling. And rather than us just saying, look, here's a check for 5 million, well, you already owe us 3 million, we'll give you a check for 2 million, plus we'll release the debt for 3. And that is what transpired. So that redress of the mis-selling of the financial products was not taxable, but crucially, it wasn't taxable under the loan relationship rules. So just an overview there on a recent court case all about the so-called loan relationship rules and when, in this particular case, they are not taxable on the release of a creditor. So if you like this video, please do subscribe, and I'll see you soon.